August 14, 2019, a CEO files paperwork for an initial public offering. His company has never made a profit, loses nearly $2 billion a year, carries $47 billion in future lease obligations against just $4 billion in committed revenue. The paperwork reveals something else: 20 times voting power for the founder, personal profits from buildings the company rents, a $5.9 million payment for a trademark he owns. 6 weeks later, the IPO was dead. The CEO was out, and $47 billion in valuation had turned to smoke. His name was Adam Neumann. Born in Tel Aviv in 1979, raised partly in an Israeli kibbutz, served in the Israeli Navy, dyslexic, struggled in school, moved to New York in his 20s with almost nothing. He tried his hand at baby clothing. It failed. He tried collapsible high heels for women. That failed too. Then in 2008, he met Miguel McKelvey, an architect with an idea. What if you could rent office space not by the year but by the month, or even by the desk? What if freelancers, startups, and small businesses could walk into a beautifully designed space, plug in their laptop, and just work? They called it coworking. And in 2010, they launched WeWork. The first location was a single floor in Soho, Manhattan. By the end of 2011, WeWork had 4 locations. By 2014, it had crossed $1 billion in valuation, officially a unicorn startup. Neumann didn't sell WeWork as real estate. He sold it as a technology company, a platform, a movement. He told investors, "We're not renting desks, we're building community. We're elevating the world's consciousness." That line, elevating the world's consciousness, appeared in WeWork's S-1 filing, in a document meant for Wall Street analysts. That's how deep the mythology ran. He hosted massive company-wide events called Summer Camp, where thousands of employees would gather, drink tequila, listen to live music. Once, he brought in Lorde to perform, and Neumann would take the stage like a rock star. One employee described it. It felt like a cult, but a really fun cult. In 2017, everything changed. Masayoshi Son, the billionaire founder of SoftBank, Japan's most aggressive tech investor, met Neumann for 12 minutes in a hotel lobby. 12 minutes. At the end of that meeting, Son told Neumann, "You're thinking too small. Think bigger." And he wrote a check for $4.4 billion. It was the second largest private investment in a US startup ever. WeWork's valuation jumped to $20 billion, then $30 billion. Then in January 2019, after another round of SoftBank funding, it hit $47 billion, more than Delta Airlines, more than FedEx, more than Ford Motor Company, a company that rents desks. Flush with cash, WeWork went on a spending spree. It opened locations in over 100 cities across 29 countries. It acquired smaller co-working companies. It launched side businesses, WeLive, residential apartments, WeGrow, a private school run by Neumann's wife Rebecca, WeBank, WeMeet. Yes, really. Neumann bought a $60 million Gulfstream G650 private jet. He installed a marijuana smoking room in the plane. He partied with employees, sometimes until dawn. He surfed before meetings and arrived barefoot to investor pitches. He was the embodiment of founder mythology, brilliant, eccentric, unstoppable. And then came the decision, the one that would destroy everything. By mid-2019, WeWork was running out of cash. Despite raising over $12 billion, the company was burning through money faster than it could bring it in. First half 2019 alone, $900 million in losses. SoftBank was tapped out. Masayoshi Son had already invested over $10 billion. His own investors were starting to ask questions. WeWork needed more capital, and there was only one place left to get it: the public markets, an IPO. Neumann had a decision to make. He could delay the IPO, clean up the governance structure, fix the conflicts of interest, get the losses under control, go public when the company was actually ready, or he could file now, with everything exposed, and bet that his charisma, his vision, and the strength of the WeWork brand would carry him through. On August 14, 2019, WeWork filed its S-1 with the Securities and Exchange Commission. The document was public. 475 pages. Every number, every deal, every risk factor visible to the world. And what the world saw was a disaster. First, the losses. WeWork had lost $1.9 billion in 2018 on revenue of $1.8 billion. It lost more money than it made. In the first 6 months of 2019, another $900 million gone. Second, the business model. WeWork signed long-term leases with landlords, average 15 years, but it rented space to customers on short-term contracts, average 15 months. If a recession hit, customers could leave, but WeWork would still owe rent on those 15-year leases. Total lease obligations disclosed in the S-1, $47 billion. Total committed revenue from customers, $4 billion. Third, the governance. Adam Neumann held shares with 20 times the voting power of ordinary investors. He could overrule the entire board. Public shareholders would have almost no say in how the company was run. And if Neumann died? The S-1 specified that his wife, Rebecca Neumann, who had no business experience beyond running the failed We Grow school, would choose his successor. Fourth, the conflicts of interest. Neumann personally owned several buildings that WeWork leased. He was effectively both landlord and tenant, profiting on both sides of the deal. He had also trademarked the word "we" personally, and then sold the trademark to WeWork for $5.9 million. His own company paid him for the right to use its own name. Within hours of the S-1 being made public, the financial press tore it apart. The Wall Street Journal, WeWork's IPO prospectus is a mess. Bloomberg, the company that loses $219,000 every hour. Business Insider, WeWork isn't even close to being profitable. Fortune called the filing bananas, bonkers, and unbelievable. The IPO roadshow, where Neumann would pitch institutional investors, was scheduled to begin in early September. But investors didn't want to hear it. Fidelity, one of WeWork's largest private investors, had already slashed its internal valuation by a third months earlier. Now, with the S-1 public, other investors followed. The target IPO valuation started at $47 billion, then dropped to $30 billion, then $20 billion, then $15 billion. On September 13th, WeWork made desperate changes. Neumann agreed to cap his voting power. He returned the $5.9 million for the trademark. The board announced new oversight. It wasn't enough. On September 17th, WeWork postponed the IPO indefinitely. The bankers, J.P. Morgan and Goldman Sachs, who had been promised massive fees, couldn't get the deal done at any price. The collapse was swift. September 17th, IPO postponed. September 22nd, the Wall Street Journal reports that WeWork's board is planning to remove Neumann as CEO. September 23rd, SoftBank, WeWork's largest investor, publicly states that Neumann must go. September 24th, Adam Neumann resigns as CEO. He stays on as non-executive chairman. Two executives, Artie Minson and Sebastian Gunningham, are named co-CEOs. Internally, WeWork was in chaos. The company was burning $47 million a week. Without the IPO, it would run out of cash by November. Employees leaked stories to the press. The marijuana room on the private jet, the tequila parties, the time Neumann brought a cereal box full of weed to a meeting in Israel. Rebecca Neumann, his wife, had reportedly fired employees because she didn't like their energy. The mythology was crumbling, and behind it was something uglier, a company built on hype, funded by a billionaire who believed his own story too much, run by a CEO who thought the rules didn't apply to him. On October 22, 2019, SoftBank announced a rescue deal. $5 billion in new debt and equity, another $1.5 billion accelerated from a previous commitment, and a tender offer to buy up to $3 billion in stock from existing shareholders. At $11.60 per share, the deal valued WeWork at $8 billion, from $47 billion to $8 billion in 2 months. But here's the most shocking part. Adam Neumann, the man who had destroyed the company's value, who had been forced to resign, whose personal conflicts of interest had torpedoed the IPO, walked away with $1.7 billion. He sold nearly $1 billion of his stock to SoftBank at the inflated price. He received a $185 million consulting fee. SoftBank paid off $500 million in personal loans he had taken against his WeWork shares. Total package, $1.7 billion. Meanwhile, WeWork announced layoffs. 2,400 employees, 1/5 of the workforce, were let go. Many had joined because they believed in Neumann's vision. Some had taken below-market salaries in exchange for equity that was now nearly worthless. They got severance checks. Neumann got $1 billion. The deal sparked outrage. Howard Schultz, the founder of Starbucks, said publicly, "Bill Ackman has blood on his hands for being the architect and recruiter of Adam Neumann." Ackman had been an early investor who pushed for Neumann to be CEO. SoftBank itself faced a shareholder lawsuit. Investors accused the company of rewarding failure. And Masayoshi Son, the billionaire who had bet $10 billion on Neumann after a 12-minute meeting, admitted on an earnings call, "My investment judgment was poor. I was foolish." WeWork limped forward under new management. A real estate veteran named Sandeep Mathrani took over as CEO in February 2020. His job, cut costs, renegotiate leases, try to make the business sustainable. Then, in March 2020, the world shut down. The COVID-19 pandemic devastated the office market. Companies that had rented WeWork space canceled contracts. Freelancers stayed home. Startups went remote. WeWork's revenue collapsed. In October 2021, WeWork finally went public, not through a traditional IPO, but through a SPAC merger. A special purpose acquisition company called Boaks bought WeWork and took it to the NASDAQ. The valuation, $9 billion. Far below the $47 billion peak, but still, billions of dollars for a company that had never made a profit. On the first day of trading, WeWork's stock rose 13%. Some investors still believed. They were wrong. From 2020 to mid-2023, WeWork lost $11.4 billion. In August 2023, the company issued a going concern warning, a formal notice that it might not survive. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy in New Jersey. The stock, which had traded as high as $13 after the SPAC merger, fell to 84 cents. Market cap, $44 million. Less than what Adam Neumann spent on his private jet. In May 2024, a judge approved WeWork's restructuring plan. The company emerged from bankruptcy with about 337 locations, down from over 500, and a new ownership structure. A real estate software company called Yardi Systems became the majority owner. Post-bankruptcy valuation, $500 million. And Adam Neumann? In 2024, he launched a new company. It's called Flow. It's a residential real estate business that develops apartment buildings with shared amenities and community spaces. It raised $350 million from Andreessen Horowitz, one of Silicon Valley's most prestigious venture capital firms. Neumann is back, and investors are betting on him again. So what do we take from this? The story of WeWork is not just the story of one bad CEO or one failed company. It's a story about what happens when narrative becomes more important than numbers, when charisma is mistaken for competence, when investors stop asking the hard questions because they're afraid of missing the next big thing. Adam Neumann made one decision: to file the S-1 on August 14, 2019. He could have waited, cleaned up the governance, fixed the conflicts, delayed the IPO until WeWork was actually ready. But he didn't. He filed. And he filed with everything exposed. Why? Because he believed his own story. He thought he was untouchable, that his vision, his charisma, his ability to make people believe would be enough. He was wrong. The WeWork collapse exposed something deeper. In the late 2000s, private tech companies were staying private longer, raising enormous sums at enormous valuations, often based on projections, not performance. SoftBank's Vision Fund alone deployed over $100 billion, much of it into companies that were losing money hand over fist, but promised exponential growth. WeWork, Uber, DoorDash, Airbnb, all went public or came close at valuations that assumed infinite growth in infinite markets. When WeWork's IPO failed, it sent a message. The public markets won't accept private market logic. They want proof. They want sustainable unit economics. They want governance that protects shareholders, not founders. WeWork also revealed the danger of founder worship. Adam Neumann was treated like a visionary. Investors gave him billions with almost no oversight. Employees followed him like disciples. The press wrote glowing profiles. But underneath the mythology was a simple truth. He was renting office space, taking long-term leases, spending millions on design, and subletting short-term at a markup. That's not technology. That's not a platform. That's arbitrage. And in a recession, that arbitrage collapses. The final lesson is about accountability. Adam Neumann walked away with $1.7 billion. The employees who believed in him got severance checks and worthless stock options. The investors who trusted him lost tens of billions. SoftBank paid the price for its own hubris, but Neumann, he's back, building a new company, raising hundreds of millions, because in Silicon Valley, failure is forgiven, as long as you tell a good story. Every market creates its myths, its heroes, its villains, its moments of extraordinary ambition and extraordinary delusion. WeWork is one of those stories, a $47 billion unicorn that became a cautionary tale. A CEO who believed he could change the world and instead destroyed billions in value in 6 weeks. At Market Narratives, we tell the stories that shaped financial markets, not the sanitized press releases, not the LinkedIn success posts, the real stories, the decisions that made fortunes and the decisions that destroyed them. Because markets aren't just numbers, they're people making choices, taking risks, sometimes winning, often losing. If this story made you think, if it changed how you see startup valuations, founder worship, or the power of narrative in finance, then we've done our job. There are hundreds of stories like this, companies that rose from nothing and fell just as fast, CEOs who made one decision that changed everything, markets that moved on a single data point. Subscribe to Market Narratives, because the next great financial story is already unfolding, and you'll want to be there when it breaks.